When we screen an ETF, we look at expense ratios, liquidity, and the total cost of ownership. So it's really how we transact and how much it's going to cost for us to own. So it's not always the cheapest ETF, but rather the one that's easiest for us to trade. So we do look to our liquidity providers, those that create and redeem shares for us, to give us some guidance as to which ETFs are best suited for the tactical nature of our strategy. At the beginning of the year and at the end of last year, we found that the markets were exhibiting significantly less risk. So we put a lot of risk into our portfolio. We're allocated into equities. In April, we began to see some unusual behavior in assets during the easing in Japan, and so we began cutting our risk in our portfolio, taking down our emerging exposure as well as our foreign equity exposure, and transitioning that to shorter duration fixed income. It was more a rebalancing of the portfolio and cutting risk as opposed to a singular opportunity. We're above our benchmark from a risk perspective, so to us, allocating, overweighting equities still makes a good deal of sense. It's just less profitable, I believe, at this point than it was at the beginning of the year. Now the markets could cut either direction from here. If we begin to see significant stress and more negative news and fearful investors, then we're going to take some risk off the table. But there is a potential for positive news emanating from Europe and potentially some surprises in the industrial demand, and I think that could lead the markets up higher at this point.